Hello everyone and welcome to today's Rajhi Bank Q3 2025 earnings call. My name is Sam and I'll be the call moderator today. All participant lines are currently muted. After the prepared remarks, there will be a question and answer session. If you would like to register a question throughout the call, please use the raise hand button found on your WebEx toolbar. I'd now like to hand you over to the host for today's call, Dr. Sultan Al-Tawaim, Head of Research at Rajhi Capital. So please go ahead.
At Tawaim from Rajhi Capital. We are pleased to host Rajhi Bank Q3 2025 earnings call. Welcome everyone to this event. Without any further delay, I will hand it to Mr. Sulaiman Al-Quraishi, the Head of Investor Relations, to introduce the management team. Please, the floor is yours.
Thank you, Dr. Sultan. Good day, everyone. And thank you for joining the call. With us on the call today, our Group CFO, Mr. Abdulrahman Al-Fadda, and Treasury Group General Manager, Mr. Abdulrahman Al-Ajjaji. We apologize due to an emergency. Our Managing Director and CEO, Mr. Walid Al-Maqbil, current CFO. Our CFO, Mr. Abdulrahman, will cover the results highlights and strategy performance. Then he will cover the financial performance in more details. At the end of the call, we will open the floor for your questions. Please note that the results presentation is now available in both the Rajhi Bank website and the Rajhi Bank IR app. And now, I'll hand over to Mr. Abdulrahman.
Thank you, Sulaiman. Welcome everybody, and thank you for joining our earnings call for the third quarter of 2025. On behalf of Walid Al-Maqbil, our MD and CEO, I will start by highlighting our performance, followed by an overview of the strategy, harmonize the group, then I will cover the financial performance in more details. Now, let's take a closer look to our performance for the first 9 months of 2025. In the last quarter, the bank has delivered an excellent performance supported by our strategy execution and improved economic environment, resulting in an outstanding net income of 18.4 billion, alongside with a healthy balance sheet growth. Starting with the balance sheet, we are able to deliver 9% growth year to date, with a total asset standing at almost 1 trillion riyal plus. This asset growth was primarily driven by 9% year to date increase in our net financing book. On the liability side, our total liabilities stand at 922 billion, reflecting 8% increase year to date, which bring our regulatory LDR at approximately 81%. Moving to the profitability, our net income reached 18.4 billion for the first 9 months of 2025, higher by 30% compared to the same period in 2024. Net yield income grew by 21%, while the non-yield income have increased by a healthy growth of almost 29%. This resulted in a total operating income increase of almost 23%, reaching almost 29 billion SAR. Regarding the credit quality, we continue to maintain best-in-class asset quality with a cost of risk around 31 basis points. Additionally, our NPL ratios stand at 76 basis points, supported by a healthy coverage ratio exceeding 150%. On the ratio side, our market-leading cost-to-income ratio has further improved to 22.5%, supported by our operational efficiency. The bank also maintained a strong financial position with a total capital of 21%, well above the regulatory minimum requirement. Lastly, our NIM maintained at 3.09, supported by our focus in enhancing the yield and optimizing the bank cost of fund. Moving to the next slide to highlight the progress against execution of the harmonized group strategy. As you know, that we started the strategy back in 2024 when we highlighted the key KPIs of the strategy. Allow me to elaborate further in our strategy, starting with the first pillar, business to consumer. Our focus on the retail cross-selling is a primary goal of the strategy, evidenced by increase in the product per customer ratio, which has increased to almost 45% compared to almost 38% in 2023. Additionally, our sales from the target customer portfolio has increased by almost 300% compared to 2023, backed by our effort to expand our customer base across both existing and new segments. Our universal offering and a financial solution have made us the bank of choice for over 20 million customers, while we maintaining our customer satisfaction, reflecting a net promoter score of 85. Moving on to the second pillar, B2B, our corporate portfolio have increased, reaching almost 270 billion, 23% higher year to date and 30% year on year. This growth has resulted from an ongoing effort to expand the wholesale lending and focus more on the SME, which has grown massively by almost 35% year to date and 52% compared to the same period last year. SME now represent 20% of our total non-retail book and almost 7% of our financing book. The bank focus in developing investment banking businesses is a key aspect also for our strategy to enhance the non-yield income, where the revenue from investment banking activities have grown by almost 220% since 2023. Looking at the third pillar, support businesses, we continue to invest in technology and automation across the group to drive innovation and operation excellence, reflected by the percentage of processes automated that reached almost 58% as of the third quarter of 2025. While percentage of the application that is cloud ready has increased to 89%, supporting our strategy on becoming a cloud ready bank. Finally, on the digital and data pillar, our digital to manual ratio has further improved to 96:4 by the end of the third quarter of 2025, highlighting our digital expansion. In addition, AI and event-driven activities are gaining momentum, generating revenue through data-driven marketing, which has increased by almost 360% since 2023. Now, I will go over the financial performance for the third quarter in further detail. Our total balance sheet stood at 1059 billion as of the third quarter, almost 17% increase year on year and 2% on a sequential basis. To analyze the 9% increase year to date, as you can see on the bottom left-hand side of the chart, mainly driven is by the increase in our financing book by almost 9%. I'll cover the financing book in further detail in the following slide. Our total funding has also increased by 9%, mainly driven by almost 6.7% increase in our customer deposit, while we've seen a further improvement into the other line items within the total funding to reflect the management initiative to diversify our funding sources. Zooming further into the main driver of the balance sheet movement, our total financing book stands at 756 billion as of the third quarter, almost 16.5% increase year on year and 2% on a sequential basis. To analyze the 9% increase year to date, as you can see on the top right-hand side of the chart, our mortgage book have increased by 4%, ex-mortgage of the retail book having almost flat, which will bring the total retail book growth of almost 3%. Corporate and the SME have grown by 21% and 35% respectively. Mortgage book stand at 278 billion, which represent almost 56% of our non-retail the retail book and almost 36% of the overall financing book. It's worth to highlight that in the third quarter of this year, we securitized close to 5 billion of a mortgage book and almost 2 billion of ex-mortgage of the retail book. Our total customer deposit stand at 670 billion riyal, almost 8% increase year-on-year and 4% increase on a sequential basis. Our CASA as a percentage of the overall customer deposit have dipped to almost 65.6% compared to 68.4% in the second quarter. To analyze the 7% movement of our total customer deposit, as you can see on the bottom right-hand side of the chart, our CASA went lower by almost 4%. If you recall, in the first quarter, we have seen a transitory deposit that has moved and impacted the CASA balances. Nevertheless, removing that one-off factor, our CASA has been increasing quarter over quarter. Time deposit has increased by almost 38% to improve further our funding profile and support the balance sheet growth. Our investment book stands at 179 billion as of the third quarter, which is almost where the book is 87% sukuk and murabaha wasama, 75% of the book is fixed rate, and finally 83% of the book are domestically. If we move to the profitability section, our net income for the third quarter were almost 6.4 billion, 25% increase year-on-year and 3% increase on a sequential basis. To analyze the 3% sequential movement, as you can see on the bottom left-hand side of the chart, NII went lower by 11 million, and non-yield income have shown a healthy growth of almost 13% on a sequential basis, while OPEX have increased by 3%. That has bring our pre-provision profit to be higher by almost 3% on a sequential basis. Our net income of the period is at 18.4 billion, 30% higher year-on-year. And the driver, as you can see on the bottom right-hand side of the chart, our NII have increased by almost 3.8 billion, non-yield income by almost 1.6 billion, offset by increase in our OPEX by 500 million, which will bring our pre-provision profit to be higher by almost 28% year-on-year. To further zoom in into the net income driver, I will start with the operating income. Our operating income for the Q3 were at almost 9.9 billion, 17% increase year-on-year and 3% increase on a sequential basis. Our total operating income for the period were at 28.7 billion, 23% higher year-on-year. And the driver, as you can see on the top right-hand side of the chart, our NII have increased by 21%, supported by increase in our average earning asset by the similar magnitude. Our fees have increased by almost 27% year-on-year. The fees growth that we have delivered is a part of the management initiative to execute the 2026 strategy by focusing on the fee income, leveraging from the cross-sell, and further improving on some of the few line items. We have seen a healthy growth in the payments, trade, cash management, investment banking activities through our subsidiary, Rajhi Capital. Exchange income have increased by 15% year-on-year. Other income have increased by almost 51% year-on-year. The two main drivers are as follows. The upfront gains in securitizing some of the transactions that I have highlighted in the third quarter, coupled with a further improvement into the mark-to-market and the dividend, finally on the derivative business as well. Our NIM for the period stand at 3.09, 1 basis point higher compared to the same period last year. It's worth to highlight that our NIM for the third quarter had dipped by almost 14 basis points on a sequential basis, and the driver as follows. We have seen the gross yield has increased by 2 basis points. However, the cost of fund has increased by 16 basis points in the third quarter, giving the liquidity premium that we've seen recently. Moving on, our OPEX for the third quarter is at 2.2 billion, 7% higher year-on-year and 3% on a sequential basis. Our total OPEX for the period were at 6.5 billion, higher by almost 9% year on year. The main driver of the increase in our OPEX are coming from the salaries coupled with the depreciation. All those increases are enablers for the management to execute the 2026 strategy KPIs. Our cost to income dipped by almost 293 basis points, reaching a leading cost to income ratio in the market at 22.5%. That drop in our cost to income ratio has been reflected by the growth in our operating income of 23% higher year on year, offset by OPEX increase of almost 9%. Very healthy positive jaws, and the management will continue to focus in further maintaining a very healthy positive jaws over the medium term. Our net impairment charge for the third quarter was 570 million, 17% lower year on year. Cost of risk at 31 basis points, 2 basis points lower compared to the same period last year. Our total net impairment charge for the period was at 1.7 billion, almost 8% increase year on year. It's worth to highlight that although that our gross charge has increased by 1.2 billion, as you can see in the bottom left-hand side, the increase in the provision charge was almost 43%. However, that has been offset by a very healthy growth or improvement in our recovery, where our recovery have improved by almost 91%, where we have delivered almost 1.1 billion improvement in our recovery. The recovery improvement is a part of the management initiative as a strategic and a sustainable business model to negate the increase in the gross charge. It's worth to highlight that the recovery for the first 9 months of 2025 equate to the full 2024 recovery. Our NPL balance stands at 5.8 billion, almost 9% increase year on year, and we've seen a growth or increase in our retail NPL by almost 389 million year to date. The movement, as you can see, is although that we have written off almost 3.6 billion, however, offset by further inflow of around 4.1 billion. Our NPL ratio stands at a 76 basis point, 3 basis point lower year on year, and 2 basis point higher on a sequential basis. Our retail NPL at 43 basis point, while our corporate NPL at 1.36%. NPL coverage stands at a healthy level of 151% plus. Our ECL stock stands at 8.8 billion, and as you can see on the top right-hand side of the chart, we have further increased our non-retail book, given that we've seen a very healthy growth in our corporate and the SME book. Stage 1 exposure stands at 742 billion, close to 97.1% compared to 96.7% at the same period last year, which shows the healthy origination of the new book from last year till today. Our stage coverage, no material movement. Stage 1 at 37 basis point, stage 2 at 11.4%, and finally stage 3 at 56.3%. Our HQLA balance stat at 122 billion riyal. Although that our headline LDR stand at 112.8%, but if you include the Sukuk and the other syndicate, the LDR will go lower to 93.5%, while the regulatory LDR at 81.2%, all above the minimum regulatory requirement. LCR and NSFR at a comfortable level and above the minimum regulatory requirement. Our total RWA stand at 670 billion, almost 16% higher year on year, mainly driven by the healthy growth in our financing book. It's worth to highlight that our RWA density stand at 63 65.3% compared to 64% at the same period last year. Our CET1 ratio have improved to 15.9%, Tier 1 at 19.7%, and total capital at 21.1%. We've seen a 44 basis point improvement in our Tier 1 ratio, as you can see on the bottom right-hand side of the chart, whereby the credit portfolio growth coupled with the dividend distribution have contributed to almost 350 basis points of a drop in our capital ratio. However, there has been a 300 basis point offset of an internal capital generation, giving the healthy RWA density of our financing book. Retained matrices have further improved and are considered to be leading in the industry, where we have further improved our ROA to 3.83% compared to 3.45%. Our ROE further expanded to 23.55% compared to 20.5% in the same period last year. Finally, our ROA have further improved from 2.2 to almost 2.4% in the third quarter. At the macro level, I think the economy is still, we've seen the second quarter GDP flash estimate, where it's estimated to further expand by almost 4%, driven by almost 4.6% growth in our non-oil GDP. IMF revised the full 2025 to 4% and maintaining the same for 2026, which shows a very healthy macro outlook for the Saudi economy. Consumer spending is still improving, where we have seen a 10% increase year on year. On the interest rate, we still factor in a couple of 1 to 2 rate cuts by the Fed between now till the year end. It's worth to highlight that we have seen SRC have reduced the mortgage origination for a 20 years mortgage origination to almost 7.1% compared to close to 7.4% in the second quarter of 2025. Having said that, we kept our guidance unchanged for our financing book, given that we have seen a further corporate repayment in the fourth quarter. We've downgraded our NIM guidance to be between -5 to +5, take into consideration the current liquidity premium. In the third quarter, SOFR SAIBOR spread were at around 119 basis points versus what we have seen as of today, around 125 basis points. Cost income ratio, we have upgraded our guidance to be below 23% and the ROE to be above 23%, cost of risk to be in the range of 25 to 35 basis points, and finally our Tier 1 capital to be above 20%. Now, I will open the questions or open the floor for a Q&A session. Sam, back to you.
Thank you. If you would like to register a question, please use the raise hand button found on your WebEx toolbar. Please hold whilst we allow the questioners some time to queue. Thank you. Perfect. So our first question today comes from John Peace of UBS. Please unmute locally, John, and proceed with your question.
Hi there. Thanks for taking the question. First one, please, is on the non-interest income growth. I just wondered, I know you don't tend to guide on that line item, but it's been growing, extremely quickly and substantially quicker than lending growth. I know it's part of the strategy. Could we imagine it continuing to grow at these very strong rates as we go into next year in the teens or even higher? And my second question, please, is around the capital and in particular around the decision to reduce the interim dividend. Just wonder if you could give us a little bit more colour around that decision and if you're targeting a certain level of CET1 as a management team going forward. Thank you.
And I think, first of all, on the non-yield income, you know that we've been the key driver of our Harmonize the Group strategy, where we have built a universal bank offering with large customer base and satisfied customer and a scalable business. I think the whole objective is to be able to improve the cross-sell. If you see on our strategy update, the percentage of the customer base that they're having more than one product were only 38%. We managed to grow it over the last, and we are in the second year of our strategy, to almost 45%. So cross-sell, introducing a new product and services that will help us to focus into the improving the non-yield income as a contribution to the bottom line is the key priority for the management initiative. Although that we don't provide any guidance in the growth into the non-yield income, but the way that I see it, that we forecasted that the non-yield income will grow faster than the financing book growth over the medium term. If you see that our financing book have grown by almost 16.5% year on year, while our fee income has increased by almost 27%. We would like to continue maintaining that positive momentum over the medium term. As far as the second question related to on the capital and the decision to reduce the payout ratio, I think we have probably spoken about it, or we have communicated to some of you guys. When the management recommend the dividend payout ratio to the board, we usually take into consideration the following factor: the operating environment from a liquidity and a funding diversification, the growth outlook over the medium term, and finally maintaining a healthy capital ratio over our minimum requirement. Historically, we have seen an opportunity to expand our ROE by increasing our leverage and reducing the payout ratio. If you recall, between the period of 2020 till 2022, we reduced our payout ratio to in the range between 24 to 29%. But we managed to increase the ROE from 22% to from 20.5% to an average of almost 22% during those periods. This time around, given that the profitability has further improved and the growth outlook has normalized, we have taken a decision this time around to maintain a healthy capital ratio by reducing the payout ratio. I think there has been a couple of public information that most of you guys are aware of it. The increase into the counter-cyclical buffer that will be affected from May next year by almost 100 basis point increase. Second is the increase in the interest rate shock as per the Basel rule. Which the increase in the interest rate shock for the SAR has increased from 200 basis point to almost 275 basis point effective 1st January 2026. All of those public information will require us to maintain a very higher capital minimum requirement over the current level. Hence, we have taken a decision to on the short term to improve the capital ratios by reducing the payout ratio. However, the management is still are looking to maintain a healthy and go back to our historical payout ratio over the medium term while we improving the ROE.
Thank you.
Thank you. Our next question comes from the line of Chiro Ghosh from SICO. Chiro, please unmute locally and proceed with your question.
This is Chiro Ghosh. Hi, this is Chiro Ghosh from SICO Bahrain. So my couple of questions are, first is, you appear to be on a slightly deleveraging banking strategy, basically the loan to deposit is on the downward trend. So how should we see it? Is it a short-term plan, or once the interest rate comes off, you plan to again leverage your book up to boost your margin and net interest income? So some clarity on that direction would be very useful. Second one is more on the asset quality side of it. So the asset quality remains quite strong, but my only concern is because the NPL ratio is so less that the 150% odd NPL coverage has a very little, the buffer is still very thin. So how should we read it? Because the recovery was quite good this quarter. So how risky is it in the sense that uh, uh, if there are some major defaults, how well positioned are you? And on similar lines, in a downward trending interest rate cycle, is it fair to assume that the defaults will come down, or for retail loan book it kind of remains same? Yeah, these are my questions.
On the first question, on the LDR, I think on the regulatory LDR, which is the public information, at 81.2% is our LDR. The regulatory requirement is not to exceed 90%. In the organization, we have an internal risk appetite. These risk appetite are reviewed regularly by Asset and Liability Committee, and also by Board Risk Management Committee, and also the board. So this is something that is a continuous process that we are doing on a regular basis. Now, do we have an internal target? And definitely, number one is to maintain a very healthy loan-to-deposit ratio that is within the regulatory requirement, and also to within our acceptable risk appetite. Abdurrahman, if you want to add anything on the LDR?
Just one more point. If you go back in the day, specifically in 2023, the regulator has revised the existing loan to deposit ratio guidelines to comprehensively capture the bank's funding base. So the purpose of the guideline was to include weights on long term to incentivize the sector or the local banks into getting into sukuk, bonds, syndicated, to get more weight on the LDR.
On the second question related to the asset quality, first of all, you need to take into consideration the following factor. Retail, as a percentage of our financing book, stands at 64%. The retail book, which is considered to be the majority of our financing book, is well distributed among many retail borrowing customers. The credit appetite is focused in salaries assigned plus government-related employees. So we haven't seen, even during a downward or the recession, any impact into the retail MPL, giving the conservative credit underwriting standard. Now, as far as your comments into when you said that the probably NPL coverage is low, I probably disagree with that statement. And I think probably lower compared to the historical standard for a Rajhi bank. But if you compare it against the competition, as of the second quarter, the NPL coverage for a Rajhi bank were 151%. The industry-wide NPL coverage is around 154%. So that's number one. Secondly, I think you guys know us, we are a very conservative organization. Whenever we've seen any customer who's considered to be stage 2, we consider topping up our coverage in case that the customer moved to a stage 3. So that's on the asset quality. Shiro, can you repeat your third question, please?
No, first of all, I was not saying that the NPL coverage is low. It's quite good. I'm just saying that at 0.75%, the 50%, like the additional is low. That's what I was trying to say, that it is still only 0.3% or 0.35. That was the context. Anyway, my third question is, but it's clear. My third question is, does the retail default has anything to do with the interest rate cycle? I mean, if the interest rate goes down, does the retail default goes down?
Technically, conceptually, no, because all retail lending are fixed rate. So either in the higher interest rate environment, if you see when interest rate has increased from beginning of 2022, we haven't seen any material increase into the retail MPL, nor in the lower interest rate environment.
Oh, quite clear. Thank you very much for all the clarifications.
And our next question today comes from the line of Gabor Kemeny from Autonomous Research. Gabor, please unmute locally and proceed with your question.
Thank you. Hi. My first question is on the margins, please. I believe your NIM guide for 2025 leaves room for a relatively broad range of outcomes for the fourth quarter, ranging from a possible further decline to a turnaround and increase. Can you perhaps elaborate a little bit on the moving parts? And also, if you could comment on the NIM outlook for 2026 under your current baseline rate outlook. I understand that you linked the NIM outlook to the liquidity premium to an extent. Do you have a view on how the liquidity premium may develop going forward? And the final one would be just one related to a previous question on capital. Can you share any target levels of capital you have? Reason I'm asking because your capital ratios are already at relatively comfortable levels in a global context. Thank you.
The first question, the moving part on our NIM for the fourth quarter. I think there is a multiple moving parts. Number one is any change in the asset mix or any change into the repricing of the asset mix. That's on the asset side. On the liability, again, similarly, in the change into the liability mix, if we have seen a further, I would say, or drop into the CASA as a percentage of the overall customer deposit, that might have an impact into the cost of fund. Also, the liquidity premium. And I've highlighted earlier, Gabor, that the average for the SOFR spread in the third quarter was one of the highest level I've ever seen, around 119 basis point, compared to the third quarter in the 2024 of almost 100 basis points. So these are the moving part into our NIM outlook for the fourth quarter. As far as the 2026, again, and I think probably the same driver will be applicable for 2026. However, we take into a positive, I would say, outlook into the rate cut for of the Fed between now till end of 2026. That will have a positive impact into the NIM. However, as I mentioned, NIM, I think there is a multiple moving part which I've highlighted earlier. The NIM theoretical sensitivity for every 25 basis point drop into the cyber, the NIM will expand by almost 7 basis points. Again, that is a theoretical, not take into consideration the change in asset mix, nor the repricing in the asset, or in the liability mix, or repricing or a liquidity premium into the liability side. Is there any indication of the liquidity premium? How is that will move? I think I will leave it to my colleague Abdulrahman, our treasurer.
I mean, thank you, Abu Johar. I think it is a real indicator to monitor the cyber SOFR spread, which has been accelerating since the beginning of the year. However, from an ARD Rajhi point of view, we will continue to diversify our funding mix. This is a journey that we've started 2 or 3 years ago to further optimize our cost of fund, cash flow requirements, and ratios. As an example, in this quarter, we have successfully tapped into the debt capital market with a Tier 2 issuance. And we have further expanded our certificate of deposit program, which all of these transactions has taken place in the third quarter.
Last question, Gabor, related on is there any minimum capital requirement? If you recall, in one of the slides that I have highlighted about the CET1, Tier 1, and total capital, although that those are from a Pillar 1 requirement, and I'm sure that you're aware, on the Basel, they give the flexibility to the regulator on each jurisdiction to impose a Pillar 2. From a Pillar 1 plus Pillar 2, although that is not disclosed, but we would like to maintain a very healthy of at least 50 to 75 basis point above the minimum Pillar 1 plus Pillar 2.
Thank you. And our next question comes from the line of Waruna Kamaraj from SICO. Please unmute locally and proceed with your question.
Hello. Hi, good afternoon. Am I audible?
Yes, you are.
Hi. Thank you very much. I have three questions. The first one is like a clarification regarding your comment on the additional buffers that will apply from next year. You mentioned 100 basis point of counter-cyclical buffer. And did you mention that this interstage shock will go up from current 200 basis point to 270 basis point in 26? Is that what you mentioned?
Yes, January 1st.
Okay, so additional 70 basis point there, right?
Yes.
Okay, right. Thank you. And secondly, as far as liquidity premium is concerned, now, as you mentioned, the SOFR SIBOR spread was very high in third quarter, but when I look at the rate, at least rates in October, the spread has narrowed, not by much, but maybe to about, back to about 100 basis point. Or is that a fair statement, or am I missing something?
I think that categorically inaccurate statement. As of today, the SOFR SIBOR spread were at 125 basis points.
Even now, is it? Okay. Okay, right. Thank you. And then lastly, as far as the OPEX, the run rate of OPEX is concerned, now you had the OPEX is around 2.2 billion. Can we consider this as run rate going forward? Do you expect further acceleration from here?
Listen, Waruna, and I think we don't provide any guidance into the OPEX. We provide a guidance in the cost-to-income ratio. The management is not shying away from investing as long as we see the return is factored into the operating income and within to improve further or to maintain a very healthy positive jaws. Our OPEX has increased by almost 9% year on year, while operating income have increased by 23%. So we're not shying away. We'll continue to look into opportunities. Again, this is an ongoing exercise that we do on a regular basis.
Okay. All right. Okay. Thank you very much. That's it from my side.
And our next question comes from the line of Abdullah Al-Baradi from Emirates NBD. Please unmute locally and proceed with your question.
Yeah, hello, am I audible?
Yes, you are.
Yeah, thank you very much and congrats for the great results. Asking regarding the guidance. So basically, you're keeping that loan book guidance unchanged despite achieving it in the third quarter. However, you're reducing the guidance for the net interest margin. So basically, if the loan book is going to stay as is, one would expect that you're going to be less aggressive in pricing, either in terms of paying for deposits or pricing the loan books However, this is not happening. Moreover, you've mentioned that the theoretical sensitivity is 6 to 7 basis points. However, we are one cut down the road and two cuts expected this remaining of this year. However, the NIM guidance has been revised down. And we are noticing that on OTC, on fixing deposits, Rajhi usually pays more than the average. So it seems like you're still aggressive on expansion. Do you see any probability of overachieving the loan book and underachieving the NIM?
The first part related on the correlation between the financing book guidance versus the NIM. First of all, let me be 100% clear. And the management has been saying for over the last 6 to 8 quarters that the focus is onto the value rather than a volume. If you look at our financing book, probably it might be lower than the aggregate into the market, and we probably lost market share. But again, the focus is to maintain a very healthy margin. We are not aggressive into the asset origination. If you can see our pricing in the consumer loans, it is considered to be the highest in the street. That to show that we are not looking for a price war. Mortgage is being capped at the SRC. Corporate, we are, again, there has been many transactions that we walked away and we didn't like the margin and we walked away. So again, the management is not aggressive, and I wanted to be 100% clear and to reiterate the management focus is on value rather than a volume. As far as the NIM guidance and your points, if you recall, Abdullah, I've mentioned, and I think I sound like a broken record several times, NIM sensitivity is theoretical. It's not taken into consideration the change in asset mix, nor liability mix, nor the asset repricing or the liquidity premium. What we have seen, and if you recall my earlier statement, SOFR cyber spread has increased to one of the highest elevated level in the third quarter to be around average of 119 basis points compared to 100 basis points in the same period last year. Third question is related to paying up for the deposit. I'll leave it to my colleague Abdurrahman.
This is also have been mentioned several times throughout the year. The growth in demand deposits last year was driven mainly by transitory deposit from government-related entities. Now these deposits are no longer within our CASA since the beginning of the year, of the Q1 of 2025. That migration naturally has put some pressure on our cost of fund. As our CFO has mentioned, the cyber SOFR spread has widened since the beginning of the year, in addition to the increased premium on top of the benchmark to generate liquidity.
Yeah, okay. Pretty informative. One question more regarding the non-interest income. We notice you found other value extraction point given the visa regulation that now you're charging a fee on real payment if the merchant is a foreigner. Has this and other value channels took full place this year? Or are we still going to see some visa regulation changes?
If you recall, Abdullah, there has been a regulatory change that was introduced back in July, and I think the management.
I'm speaking about the response from your side. Has it taken full impact, or we should see further?
If you allow me to continue, please. So we have seen, if you recall, in the third quarter, there has been a regulatory change, and I've been transparent, and he said that the management has put lots of initiative to counter impact that changes. And I think if you see the result for the fee income growth in the third quarter, or compared on a sequential basis, you can see that the fee income has further improved in the third quarter. And I think you can see that on the second quarter, our fee income were close to 1.4 billion. Third quarter, 1.5. So, and I think the management have delivered their commitment. Now, do we see any further regulatory changes? Nothing that we are aware of.
No, I'm seeing further improvement as a precaution against those changes.
I'm not 100% clear of what you're looking for.
So you've taken a precaution measures to bring back those lost fee income. Has they taken full impact, or are we still to see further improvement in the fourth quarter?
The only comment that I can highlight is the management is still focused to improve the fee income contribution to the bottom line, whether from this initiative or any other initiatives.
Thank you very much.
Thank you. And our next question comes from the line of Mohammed Al-Rashid from Hassana. Mohammed, please unmute locally and proceed with your question.
Assalamu alaikum. Am I audible?
Yes, you're loud and clear.
Just one question from my side. We noticed that the operational risk RWA has declined by around 10 billion on a quarter-over-quarter basis. May I understand what drove such a decline? Thank you.
There has been a change into or clarification from the regulator related to the recent Basel requirement on the operational risk, mainly related to the historical losses previously, and I think that was, I think we are in line with the regulation.
Okay, so we should expect it to be a trend across the sector as well.
I can't highlight on the other banks. I only know from my side, Mohammed, every bank has its own calculation of their operational risk.
Okay, thank you, Lafia.
Thank you. And our next question comes from the line of Adnan Farouk from Jadwa Investment. Adnan, please unmute locally and proceed with your question.
Hello. Hello.
Hi there. We can hear you.
Thank you for the opportunity. I have two questions. One, I just wanted to clarify. You mentioned that there were securitization transactions during third quarter as well. You said 5 billion in mortgages and 2 billion other retail product?
Yes.
And that, can you give us an idea about what sort of gain did you book on this?
Undisclosed, Adnan.
Okay. And the other thing I wanted to ask was about exchange income. You mentioned fee income was exceptionally strong. Even exchange income was exceptionally strong this quarter. What led to this improvement? Are there any market-related factors that led to growth in exchange income, and we should see that normalize going forward? Or these are part of the harmonized group strategy, which is leading to better exchange income and should continue going forward?
Adnan, the FX income, as mentioned by our CFO, grew by 15% year over year. This is mainly due to our clear strategy, which we've been mentioning, to increase market share in both retail and corporate segments. We have focused on better improved pricing, improved customer experience, and enhanced our digital offerings. The strategy has worked very well, and we expect the growth momentum to continue going forward.
Also, if you have that, Abdurrahman, on the exchange income as well, and I think you guys know that Rajhi Bank started as an exchange company back in the 1955. We do have the highest market share in the remittance business, and this is something that I would like to highlight. These are strategic initiatives that has been highlighted by my colleague Abdurrahman, and we'll continue to focus to further improving our position in the remittance business.
Great. Thank you so much.
Our next question comes from Mehmet Sevim of JP Morgan. Mehmet, please unmute locally and proceed with your question.
Good evening. Thanks very much for taking my question. I just wanted to come back to your comments on the dividend payout. I was just wondering if you think you addressed your wish to improve the capital buffers now with the dividend decision that you took for this quarter, or will we see the payout at these levels for the coming period as well? I know you mentioned the medium term, but just wanted to come back to this comment. And also, you highlighted the public announcements recently for capital regulations, including the countercyclical buffer and the RRBB. Is there anything else you think that may come at some point? For example, maybe a potential increase in the DSIP buffer or anything like that, which makes you a bit more cautious right now? Thank you.
Thanks, Mehmet, for again coming to the points related to the dividend payout ratio. I think we are reviewing the environment, reviewing the operating environment on a regular basis. This is something that we believe that it's the decision to reduce the payout ratio is a short term to improve the buffer. We will monitor the situation on a regular basis. And I think the management direction over the longer term to go back to the historical payout ratio while maintaining and expanding our ROE. So this is something that we will review on a regular basis. And we believe that is only short term, but over the medium term, we'll continue to go back to our historical payout ratio. As far as if there is any other capital requirement that we are anticipating from the information that we are having and the dialogue that we're having, we're not aware of any further changes into the capital requirement as we speak.
Great. Thanks, Abdulrahman. Much appreciated.
Unfortunately, we have run out of time for any further questions. So at this time, I would like to hand the call back over to the CFO, Mr. Abdulrahman Al-Fadda. Please go ahead. Hi there, Mr. Abdulrahman Al-Fadda. I think we are muted in the room. Hi there, team. Just confirming that we're still not receiving any audio from the room.
Sam, I'm audible now?
Yes, you're loud and clear.
Yeah, so I was saying thank you, everyone. Thank you, everyone, for joining the call, and wish you all the best. And hopefully we'll speak to you soon in our full year earning call. Wish you all the best. Good luck. Assalamu alaikum.
This concludes today's webinar. Thank you all for joining. You may now disconnect.